On this channel, we've published videos about both Rivian and Volkswagen in the past. Both automobile makers are struggling for different reasons. Due to the high price points, Rivian is having trouble selling the cars it produces, and its production costs are so high that the company loses tens of thousands of dollars for every car it sells. Volkswagen's core business is still profitable, but its market share is shrinking as it struggles with the transition to EVs. One of the key bottlenecks at Volkswagen is its software, which is notoriously bad. In June of 2024, Volkswagen agreed to invest up to $5 billion into Rivian. The two companies will also create a joint venture. On November 12th, they expanded the size of the deal to $5.8 billion. In this video, we'll analyze the Rivian-Volkswagen joint venture and see whether or not this will be enough to save either company. As we will see shortly, software is at the heart of the Rivian-Volkswagen joint venture. Software is becoming increasingly important for almost all industries in today's increasingly digital world. From a career perspective, understanding coding and software has never been more important. And thanks to today's video sponsor, Brilliant, you don't need a computer science degree to start learning. Brilliant is a learning platform offering courses in data analysis, programming, math, and more. Their first principles approach helps you build understanding from the ground up. Each lesson is filled with hands-on problem solving that lets you play with concepts, a method proven to be 6 times more effective than watching lecture videos. For example, with their programming courses, you can get familiar with Python and start building computer programs on day 1 with a built-in drag-and-drop editor. You can even learn how to build a large language model. With Brilliant, you can become a little bit more knowledgeable each day. It's like the opposite of mindless scrolling. To try everything Brilliant has to offer for free for a full 30 days, visit brilliant.org/wallstreetmillennial or scan the QR code on screen, or you can click on the link in the description. You'll also get 20% off an annual premium subscription. And now back to the video. Rivian is considered by most analysts to have some of the best software and electrical architecture in the industry. This software includes a central infotainment system which the driver can use to control various aspects of the car. Building this kind of software is surprisingly difficult. The infotainment system needs to communicate with all the various electronic systems in the car. Rivian built its own software and electrical architecture from the ground up. The electrical architecture refers to small computers and other electronic components throughout the body of the car. These computers control things like the electric motors, climate control, lights, rear view camera, etc. It is highly customizable, allowing for new features to be added seamlessly. Bugs can be fixed via over-the-air software updates. Volkswagen has been making cars for almost 100 years. A lot of its design philosophy is outdated. Volkswagen also relies much more heavily on external suppliers for many of its parts. It can be very difficult to get many different parts from dozens of different suppliers to talk to each other and be controlled by one central software. In an effort to catch up to Tesla and other EV startups, Volkswagen added a bunch of new software features to its electric vehicles. Unfortunately, the software was extremely glitchy and unreliable, causing numerous customer complaints. Some customers have gone so far as to say that the glitchy software makes the car all but undrivable. Volkswagen has spent billions of dollars trying to develop its own software and electrical architecture internally, but with very little success. That's why they wanted to form a joint venture with Rivian. The joint venture will develop software and electrical architecture which will be used in both Rivian and Volkswagen's future cars. Importantly, on day 1, Volkswagen receives a license to use Rivian's existing software and electrical architecture. Rivian has some of the best software in the industry, while Volkswagen is one of the worst. Gaining access to Rivian software could be a game changer for Volkswagen, but this will come at the price of a very high cost. Over the next 4 years, Volkswagen will invest up to $5.8 billion into Rivian. This investment is split up into 6 tranches. Rivian received the first tranche in June of 2024. This took the form of a $1 billion convertible bond, which will convert into equity in December of this year. In November of 2024, they also received a one-time cash payment of $1.3 billion from Volkswagen. This is consideration for licensing Rivian's existing software. In 2025, Volkswagen will invest a further $1 billion to buy newly issued Rivian shares at a 33% valuation premium to the trading price at the time. However, this investment is conditional on Rivian achieving 2 consecutive quarters of positive gross margins, or 2 non-consecutive quarters of gross profit above $50 million. Currently, Rivian's gross margins are extremely negative, so it may be difficult for them to meet this condition. We'll discuss this in more detail shortly. By 2026, Volkswagen plans to have developed new vehicles using the software and electrical architecture created by the joint venture. If these new vehicles successfully complete winter testing, Volkswagen will invest another $1 billion into Rivian. This investment will take the form of both equity and a convertible bond. Volkswagen will give a $1 billion loan to Rivian, which will mature after a period of 10 years. Finally, in January of 2028, Volkswagen will invest $460 million to buy newly issued Rivian shares at an 84% premium to their market price at the time. All of this together adds up to $5.8 billion. Employees from both Rivian and Volkswagen will work for the joint venture. For the first 4 years, Volkswagen agreed to pay for 75% of the joint venture's operating costs, while Rivian will pay for the remaining 25%. On the surface, this partnership seems to make a lot of sense. Volkswagen has cash that Rivian desperately needs. Rivian has software and other technology that Volkswagen desperately needs. So let's dig a little deeper and see what this partnership will do for each company. Prior to Volkswagen's initial investment in June of 2024, Rivian had approximately $7 billion of cash on its balance sheet. While this sounds like a lot of money, Rivian burned almost $6 billion of negative free cash flow in 2023. Thus, the $7 billion of cash on hand would only last them a little over 1 year. Rivian is nowhere near profitability. They needed to raise capital, they didn't have any other choice. That's why they agreed to a joint venture with Volkswagen. Volkswagen is one of the few entities in the world that is willing and able to invest billions of dollars into Rivian. To date, Rivian has received $2.3 billion from Volkswagen. This will only extend their runway by another couple of quarters. In 2025, Rivian can get another $1 billion from Volkswagen, but only if they achieve 2 quarters of positive gross profit. Rivian has never sold a car for more than it costs to produce. Over the past year, Rivian has incurred a gross loss of approximately $40,000 for each car it sells. Rivian claims it will achieve positive gross margins by the 4th quarter of 2024. However, there are strong reasons to be skeptical of this. In the 2nd quarter of 2024, Rivian retooled its factory in Normal, Illinois to start producing the 2nd generation of its R1T and R1S cars. They claim that the 2nd generation has much lower material costs and can be assembled faster than the 1st generation. This will allow them to achieve positive gross margins by the 4th quarter. If this were true, you would expect to see profitability improve in the 3rd quarter, as this is the first full quarter after the retooling. But as it turned out, the opposite happened. In the 3rd quarter of 2024, Rivian lost $39,000 for each car it sold. This is $6,000 worse than the 2nd quarter. So why are the numbers moving in the wrong direction? Shortly after reporting these disastrous numbers, Rivian CEO RJ Scaringe went on CNBC to explain.
Look, Morgan set it up there. You guys had a wider than expected loss in the 3rd quarter. You guided to a wider than expected loss for the year. You're trending in the wrong direction in terms of loss per vehicle. What happened?
Yeah, I mean, this is our core focus is on driving towards profitability. We talked about our objective of getting to positive gross margin in Q4. Q3 is really a hard quarter to see through a lot of the noise. We just made a big changeover to our 2nd generation of our R1 vehicle. And so there's a lot of costs associated with changing out roughly half of the bill of materials as measured by cost. And so as we brought on new suppliers, there's expenses associated with that. We also had a supply chain shortage as part of this ramp up, and that really hurt us in terms of our overall output for the quarter, which affected us in terms of fixed cost absorption across all the different vehicles. But we remain optimistic around overall performance, and looking at Q4, we've continued to guide towards positive gross margin.
How do you get there? How do you get to positive gross profit in Q4 after the losses we've seen?
Yeah, I mean, one of the things when you've got so many different changes, we've talked about how do you sort of decipher that and look through the noise to see what's the real signal. The thing I'd call out is if we look at Q4 of this year, so this quarter, relative to Q1 of this year, and look at the difference in our material costs for the vehicle, we're 20% lower in Q4 than we are in Q1. And that sort of helps you see through some of the noise. So we've made real progress in terms of the overall material cost structure on the vehicles. And then, of course, we're continuing to drive efficiency improvements into the plant. We're continuing to drive progress in terms of the quality of the plant and the hours per unit.
He blames the massive Q3 loss on one-time costs associated with switching to the 2nd generation, as well as supply chain issues which decreased production. He nonetheless reiterates his company's previous guidance of positive gross margins by Q4. Let's dig a little deeper to see if this is reasonable. In the 2nd quarter, production declined to under 10,000 cars. This was to be expected as they shut down the factory for part of the quarter due to the retooling. In the 3rd quarter, production rebounded to $13,000. According to RJ Scaringe, they could have produced a lot more than this had it not been for the unforeseen supply chain issue. Once this supply chain issue is resolved, they can ramp up production. However, there's a big problem with this. Despite production being lower than expected, Rivian still failed to sell all the cars that it made. They only sold 10,000 cars in the quarter. There is insufficient demand to absorb the current level of production. Even if it is technically possible for Rivian to increase production once the supply chain issue is solved, it won't do them any good if there aren't enough customers to buy the cars. The R1 cars are expensive, starting at over $70,000. Not very many people can afford to spend this much money on a car. Rivian may have already saturated the market. RJ Scaringe claims that the second generation has 20% lower material costs compared to the first generation. In the first quarter of 2024, it cost Rivian $127,000 to produce each vehicle. Not all of that cost is materials. They also have labor, fixed costs of the factory, etc. Let's assume that 50% of the cost is materials. That would be $63,500 of materials per car. A 20% reduction in materials costs will save them $13,000 per car. In the most recent quarter, Rivian lost $39,000 per car. This doesn't get them anywhere close to break even. It's difficult to overstate how dire Rivian's financial position is. As of the end of the third quarter, the company had about $6.7 billion of cash on hand. If we add the $1.3 billion payment they received from Volkswagen in November, that brings them up to $8 billion. They burn more than $1 billion per quarter. If they fail to achieve positive gross profits, they won't get any more investment from Volkswagen in 2025. This would put them on track to run out of cash around the middle of 2026. With its share price having already fallen more than 90% since its IPO, it may be difficult for Rivian to find other investors to fund its massive losses. On the bright side, even if Rivian goes bankrupt, Volkswagen will still retain the licenses to use its software and electrical architecture. Volkswagen will use these in its own future EV models. Specifically, in 2028, Volkswagen plans to release 2 new EVs in the United States under the new Scout brand. Scout was a brand of off-road capable SUVs in production from the 1960s through the 1980s. It was created by the American tractor company International Harvester. In the 1980s, International Harvester ran into financial difficulties and ceased production of the Scout. To this day, Scout remains an iconic brand among the older generations, as it was one of the first ever off-road SUVs. In 2021, Volkswagen bought the rights to the Scout brand and plans to make Scout-branded electric vehicles for the US market. Specifically, Volkswagen plans to release 2 models, the all-electric Scout Terra pickup truck and the all-electric Scout Traveler SUV. You can't help but notice that these 2 cars look extremely similar to the Rivian R1T and R1S. Not only do they look similar, but thanks to the joint venture, Volkswagen will be able to use Rivian software and electrical architecture for the Scout cars. They will be very similar to Rivian's indeed. The Traveler SUV will start at $50,000, while the Terra pickup truck will start at $51,500. This is including the $7,500 EV tax credit. So the actual list prices will be $57,500 and $59,000. This is more than $10,000 cheaper than the Rivian cars. From a competitive perspective, this could be disastrous for Rivian. As we discussed earlier, Rivian is already having trouble selling its inventory today. The introduction of a cheaper competitor in 2028 could cause Rivian to lose significant market share. With that being said, the competition from Scout may be a moot point. Given Rivian's extreme cash burn and lack of a credible path to profitability, I would be shocked if the company remains a going concern through 2028. Alright guys, that wraps it up for this video. What do you think about Rivian and Volkswagen? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.